Welcome to the Stock Market Palantir. Today we are going to talk about LAC, Lithium Americas Corp. The context here is it's really critical to understanding the violent price action we've seen recently. LAC is essentially what we call a newco, a pure-play entity whose entire valuation is pegged to one single cornerstone asset, the Thacker Pass project in Nevada. As the largest known lithium resource in the U.S., it's inherently strategic. But as a pre-revenue development stage miner, its stock is exceptionally sensitive to any news about funding. And that's led to some incredible volatility.
And that volatility is the direct result of a fundamental conflict. On one hand, the company achieved this massive strategic de-risking by securing a vital $2.23 billion U.S. Department of Energy loan. That solved the single greatest financing risk to the project. But on the other hand, that operational certainty came at a significant and I'd say permanent cost: immediate shareholder dilution.
So the debate is clear. Does the stock's current valuation correctly reflect the guaranteed operational certainty and the, strategic importance of this 85-year asset? That is my position, that the long-term project value just outweighs the cost. Or must we focus, as you argue, primarily on the permanent impairment of existing shareholder value caused by that dilution?
Precisely. I maintain that the cost of capital in this deal was simply too high, and it fundamentally weakens the long-term value proposition for existing equity holders, regardless of how strategically important the asset is to the country.
I see why you prioritize the per-share value, but that market surge, even if it was initially just fueled by rumor, it correctly priced in the removal of the existential threat to the project. We're talking about a pre-revenue company that suddenly had phase 1 of Thacker Pass fully funded all the way through to its crucial 2027 production target. The operational risk, the highest hurdle for any development stage miner, is for all intents and purposes solved. This asset is now secured by two very powerful partners. General Motors invested $650 million and secured 100% of phase 1 offtake for 20 years. And the DOE loan aligns LAC directly with national strategic interests. Look, this isn't just a plan on paper. Engineering is over 80% complete, and there are 700 personnel actively on site. Execution is happening.
That's a compelling argument about the project's stability, sure, but you're treating the cost of that certainty like it's a minor footnote, when it's the central reason for the sell-off. That correction was not irrational. It was a necessary repricing after the full terms of the deal were publicized on October 7th. The dilution was, as we've discussed, punitive. It's what we call a double-dip dilution because the DOE required warrants for two distinct things: a 5% equity stake in LAC, the parent company, and a separate 5% economic stake in the Thacker Pass joint venture, the physical asset itself. So just to be clear for our listeners, that means a permanent 10% claim on future profits and asset value that will never belong to existing shareholders. This led to, professional skepticism. We saw a flurry of analyst downgrades, JP Morgan moving from neutral to underweight immediately after those terms were digested. So, yes, operationally the stock was de-risked, but valuationally it was fundamentally re-risked. And if we want to interpret true market signals, we have to look at how the sophisticated money reacts. The most compelling piece of evidence suggesting the cost was too high comes from inside the company itself. VP Alexei Zawodzky, a key executive, sold nearly 90% of his total shareholdings. That's a $3.35 million sale on October 1st. Now, this happened after the initial rumor rally, so we got a high price, but crucially, it was before the highly dilutive terms were officially signed on October 7th. This action, it strongly suggests that those with intrinsic knowledge saw the deal as fundamentally eroding existing equity value and, they made the rational choice to cash out at the peak of the financing narrative.
I think placing so much weight on one insider sale risks confusing an opportunistic personal decision with the powerful fundamental forces that were driving the stock that day. That executive sale may have been perfectly timed, but the retail rally, fueled by the powerful government-backed narrative and, the media's next Tesla analogy, was effective because the DOE loan fundamentally threatened the extremely high short interest, which was over 28 million shares. This threat caused a forced short squeeze.
But more critically, let's just look at the options market. The open interest put-call ratio hit an extreme low of 0.35.
Okay, that 0.35 ratio that's a powerful technical indicator, but we need to unpack why it's relevant here. What does a ratio that low really signify for the everyday investor?
It signifies extreme bullishness and conviction. A ratio below 1 means there are more call options, bets the stock will rise, than put options, which are bets the stock will fall. A ratio of 0.35 means that for every dollar leveraged on the stock falling, there were nearly $3 leveraged on it rising. This demonstrates that the collective risk assessment of the leveraged market recognized that the existential project risk was resolved. That singular resolution overpowered any concern about the subsequent dilution or, insider actions. The immediate value was created by solving the financing crisis. And furthermore, the bear case often focuses on what I would call minor technical noise. For instance, the supposed Q3 earnings miss, a massive gap loss of negative 83 cents versus only negative 5 cents expected. That looks terrible as a headline, but it was an accounting anomaly, not a failure of the business plan.
But those headline numbers drive massive volume from retail algorithms. You can't just dismiss a near $1 per share loss as minor noise, especially for a zero-revenue company.
I can, because the loss was purely non-cash, and the crazy thing is it was caused by what was fundamentally good news. Let's clarify what happened with the gap rules here. LAC has convertible notes, which are a form of debt that holders can exchange for equity at a certain price. When the stock price rallies significantly like it did on the DOE news, the accounting rules require the company to book an increased non-cash liability associated with those notes.
So if I understand you correctly, the higher the stock price climbed, the more expensive it became for the company on paper because the potential liability of those notes being converted into equity just got bigger.
Exactly. The company was penalized on its income statement because its stock was performing well. It's a non-cash paper liability. It has zero impact on the actual cash the company holds or how fast they're progressing construction in Nevada. So fundamental investors look past these technical headlines toward the project's 85-year life and the macro tailwind of surging lithium carbonate prices, which were up 17% in November. That long-term strategic value is the actual driver here.
I would frame the stock's sensitivity differently. The fact that headline-driven retail traders and algorithms sold off 5.5% on a purely technical, non-cash anomaly, well, that highlights the stock's extreme pre-revenue vulnerability. While the operational risk is clearly lower now, LAC has no cash flow, and it generates significant net losses. The valuation is entirely speculative until production starts in 2027. And until then, the permanent reduction of future economic output via the DOE's 5% joint venture stake, that asset dilution, is an unavoidable long-term drag. Operational certainty is vital for the project, but we have to ask, at what price is it great for the existing shareholder?
Let me challenge this notion that sophisticated capital was just running away. The bear argument often suggests that large institutional players were quietly offloading shares, forcing the correction. But where was the selling happening? The data shows that on days of peak volatility, like November 14th, dark pool trading volume, the venue where institutional blocks are quietly executed away from the public eye, represented only about 5.2% of the total public or lit exchange volume.
That 5.2% figure is quite low. So what's the takeaway for our audience regarding that small institutional footprint?
It tells us that the price volatility was clearly being generated in price on the public exchanges by retail momentum and short covering. It was not driven by large institutional investors discreetly dumping huge positions through private markets. The price was transparently discovered where the high-frequency retail traders and short sellers were dominating the action. This just confirms the volatility was speculative and momentum-driven, not some kind of institutionally mandated selling.
I approach that data from a different perspective. While I agree the dark pools were the source of the retail volume, the sustained reaction from the professional analyst community confirms that the institutional conclusion was largely negative, regardless of where they traded their blocks. Sophisticated capital understood that using highly leveraged derivatives like that 0.35 put-call ratio implies to chase a strategic narrative while ignoring the permanent 10% combined dilution of the asset in the company was just an unsustainable valuation path. This skepticism led to the necessary price correction. The cost of capital proved too high for those focused purely on per-share metrics.
But that institutional skepticism just means they're focused on current metrics, ignoring the strategic moat that was just created by the DOE and GM backing. The asset's strategic value justifies the cost. The certainty of execution has fundamentally changed the risk profile of this company.
The asset's strategic value justifies its construction, sure, and its importance to the nation, but that certainty structurally reduces the return on that value for us, the existing shareholders. That is the tension the market is struggling to resolve right now.
Look, we have to look beyond the short-term noise and these temporary accounting hurdles. The $2.23 billion loan guarantees the development of a critical, world-class strategic asset. This project is backed by General Motors and the U.S. government. The operational risk is solved, and the long-term value creation potential of the 85-year mine life, it just fundamentally outweighs the initial one-time cost of capital.
The stock volatility in LAC is a textbook example of the conflict between project potential and existing shareholder value. While the asset's execution risk is lower, the price paid, the permanent dilution of 5% of the company equity and 5% of the joint venture itself, means existing shareholders have a significantly smaller claim on the eventual success. The market is still arbitrating whether strategic certainty justifies that steep permanent cost, and until cash flow arrives in 2027, that structural debate is going to continue to drive the price.
This discussion about Lithium Americas Corp has really illuminated the dichotomy between operational de-risking and shareholder dilution, a tension that defines the journey of many pre-revenue strategic assets.
Right. We've examined the power of that market narrative against the permanence of the dilution, and we've seen how insider sales and analyst ratings can often diverge sharply from the retail momentum that's chasing that government backing story.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.